right, well, thanks very much. Aman Chowhan is with us, a fund manager at Abakkus Asset Management. He's joining us now to take some questions. Aman, good to have you with us here. Thank you very much for your time. You know, what fresh... you guys are stock pickers, right? I mean, very bottom-up, not a very macro-ish kind of call, top-down. So let me begin by asking you, what have you done recently, in the last fortnight, maybe a little longer?
Not much. We have added more to some of the existing holdings. This based on how the corporate results have come in. So we would have added more to our financials. We would have added more towards cement. We would have added more towards some of the cap goods holdings that we have. Pharma we had added in the past, so not in the recent time. So it's the last 15 days. These would be the three sectors that we would add. Pharma would be say 2 months back. IT still neutral, so haven't done anything new on the IT front as of now.
Hi Aman, good afternoon. Aman, what about the wires and cable space? You know, you all have one big winner in there, Polycab. What's the view though on this space? Do you think plenty of room for it to go, or do you think in the near term, I think you'll have exposure only via Polycab. Do you think for the near term, some kind of consolidation would be par for the course?
I feel this consumer durables, consumer companies, wire companies, even building material companies, they're all headed for good times because one, the festive season is starting. They didn't have that good a demand in the last 2 quarters, but closer to the Diwali season, festive season, and plus state elections in November, December, followed by central elections next year. So the next 12 months looks good because we have seen ahead of the election, there's a decent amount of money which comes into the economy. The rural market is buzzing, the rural demand picks up. And this can be something which is interesting for these sectors and these stocks. And that is the reason we are staying put. We own many companies in these sectors and continue to own them and like them from a 12-month perspective.
Aman, I know you don't talk about individual stocks, but I just wanted to get your thoughts in on Route Mobile because there was this very large deal, with, I think, Opal Group, Proximus Opal Group, the Belgium-based company. How should an investor, a shareholder, look at this deal between Route Mobile and the fact that the promoters are partially exiting the company?
Yes, so as you mentioned, we don't discuss stock-specific things, but what is there in the public news is something that I can definitely tell you that the ownership has changed. Now the new owner is a global company. It's a Belgian government-backed entity with a decent presence in the US markets. Route predominantly was in the Asia-Pacific market. So it's a good, clear synergy between both the entities, and that should eventually benefit the merged entity. So clearly from a 2 to 3 year perspective, this is a growing market globally and Route is now better positions to, you can say, capitalize on that. So right now from being a regional to say Asia, Africa and Middle East, now you are also getting access to European market as well as the US market. So then you become a global player. So the ambition is to be amongst the top 3 globally, and they have all the reasons to be there for the next 2 to 3 years.
So you're more bullish on Route Mobile post the deal?
You can say that, yeah.
Okay, got that. Aman, hi, good afternoon. I was looking at the composition of the Abakkus Diversified Alpha Fund, where you have a lot of the old economy stocks, basically industrial stocks. There's NTPC, there's Larsen, there's Cummins. Then you also have a Hindalco, you have a couple of the large banks there as well. So on the industrial side of the market, what's the thought? I mean, have you been happy with the sort of earnings that have been coming through? We were just having a discussion on defense as well, for that matter. Whether it's industrials or defense or engineering, what's the criteria and the filter that you're adopting as you're looking at perhaps additions to the portfolio from here on? Because the stocks have already run up a lot.
Exactly. So pretty happy with the results, not happy with the P multiple that comes along with the results. So the challenge is where to deploy the fresh money, right? So these are good companies, still at decent valuation, but definitely you can't pay a very high multiple to them, even if they are growing pretty strongly in the near term. So outlook for these sectors, industrials, cap goods, and domestic manufacturing, defense, for the next few years is definitely positive. Now it's up to us as to what kind of valuation we would like to pay. So we are, but as you're aware, more of value-conscious investors. So we would like to strike a balance somewhere between what growth and what PE we give. So we focus much on PEG ratios. 1.5 PEG is what we are pretty comfortable at. So if the company is say growing at 30 times, I don't mind paying a 30-40 P, but I definitely do mind paying a 70-80 P. So keeping that criteria in mind, the names that you mentioned feature into a portfolio because these companies would broadly, you can say, meet the criteria that I just told you.
Okay, all right. Aman, what about Pharma? You know, that index has come back in a big way. Have you added positions out there? A couple of stocks that you'll have exposure to, I think, is Sun Pharma. But for your portfolio on the whole, have you increased the weightage?
Marginally, I'll not say much. In the last 3 months, we would have added a few bits of pharma exposure. In the last month or so, we haven't added much on the pharma bit. But whatever we have, we own it with a 2 to 3 year perspective. Pharma as a space is looking good. The high base of COVID is behind us, and the margin as well as pricing pressure in US market is also abating. So as things move ahead, from a good base, these companies can again start delivering consistent mid-teens to high-teens kind of earnings growth, and that should eventually get reflected in the stock price also. So that's broadly what the pharma view for us is.
Is that kind of going big? Are you doing it for growth, Aman? I mean, this pharma into pharma, or is a little bit of protection? Although pharma also on the downside has not offered that much protection, but you're not a team which is satisfied by mid-teens kind of growth. You look for a high growth. So just wondering.
So the whole portfolio can't be high growth. So this also brings in stability. We are, you can say, we have very few of consumer names. We have very few of high P stocks, which are very stable stocks. They offer less return, but they're pretty stable. So in a way, this also gives us stability on the portfolio front. So we compensate that the less of consumer exposure with more of pharma or IT exposure. So that is the balancing that we look forward.
Oh, okay, that's interesting. In fact, I was just noticing that I think in your top holdings, I could only spot maybe a Radico or a Reema and not too many consumer stocks, neither discretionary nor staple. So that's entirely a valuations issue, is it?
Entirely valuation issue.
Okay, got that. So talk a little more about technology. I mean, you mentioned broad thoughts on Root, but for instance, HCL Tech is a big holding in a couple of your portfolios as well. And there's been this raging debate about what lies ahead and whether we'll go back to the pre-COVID normal and whether the growth was just over-exaggerated, over-anticipated during COVID times. So where do you stand in that debate? And when you talk about holding some of these large-cap tech stocks in the portfolio, what is the earnings run rate that you'd be happy with, that you can pencil in at current valuations?
So we feel this is a year which is going to be a reset year for IT companies because what happened is during COVID time, there was a mad rush to go digital. There was a mad rush to spend and be ahead of each other on the digital front. And that is now awaiting. Lots of startups, lots of .com companies, IT budgets have also come under scanner because the easy money which was flowing through during COVID times through private equity deals for most of the startups have now stopped. So they have to be rational in their spending. And that has impacted the near-term earnings growth for the Indian IT companies. But as a business case, these companies have proven during COVID times that it is not just a cost arbitrage, but they can deliver globally, seamlessly. During the whole lockdown, there was not a single day when we would have discussed that this banking system is down, my online payment has not gone through, my online shopping has not gone through, something is not working. So digitally sitting in India, whether working from home or office, Indian IT companies are delivered, right? So that is something which is a statement, and this is going to stay for the next multi-decades now. So this is the year where the reset, because from a high base where people were desperate to spend, and they're spending big time and were okay to give even higher bidding rates, now they're getting more rational. Once that sets in this year, then from a normal base, I think high single digit to a you can say low teen for a large cap company in IT should be the norm. That should be the CAGR growth rate for the next few years. For a mid cap IT company, it's anywhere going to be say high double digits to even 20-25% growth in some companies, and that's where our focus is. So in IT also, we prefer looking at a mid cap than a large cap because the growth rate definitely is going to be much higher in the mid cap space.
Aman, thank you very much for joining in. Need to slip into a very short break, but with the news that the markets are once again down more than 100 points. When we started the show at 2:30, the Nifty was down about 50-60 points, but the cut has gotten deeper and we're at the day's low once again. Nifty below 19,430. Get into a break. We'll come back and get you a check on what dealing rooms are saying in our segment D Street Chatter. We get you a few BTST calls too.